Many companies operate in several business segments as a strategy to achieve growth and to reduce operating risk through diversification. So, for example, consider a company that operates in several distinct business segments, including computer peripherals, home healthcare systems, textiles, and consumer food products. The result of these distinctively different activities will be aggregated into a single set of financial statements that make it difficult to form an informed projection of future performance. So to address the problem, the accounting profession requires companies engaged in more than one significant business to provide supplemental information concerning individual operating segments. Note that the supplemental disaggregated data do not include complete financial statements for each reportable segment, just specified items. According to U.S. GAAP guidelines, a management approach is used in determining which segments of a company are reportable. This approach is based on the way that management organizes the segments within the enterprise for making operating decisions and assessing performance. So the segments are evident from the structure of the enterprise's internal organization. The characteristics that define an operating segment include a component of an enterprise that engages in business activities from which it may recognize revenue and incur expenses and revenues relating to transactions with other components of the same enterprise, or a component of an enterprise whose operating results are regularly reviewed by the enterprise's chief operating about decisions regarding resources to be allocated to the segment and assess its performance. A component of an enterprise for which discrete financial information is available. So for areas determined to be reportable operating segments, the required disclosures include general information about the operating segment, information about reported segment profit or loss, including certain revenues and expenses included in reported segment profit or loss, segment assets, and the basis for measurement. Reconciliations of the totals of segment revenues, reported profit or loss, assets, and other significant items to corresponding enterprise amounts, and then interim period information. This slide shows the business segment information reported by Abbott Laboratories in its annual report. Note that the business segment disclosures include a reconciliation to company totals. That is, net sales is reconciled to the company's total net sales of $21,848,000,000. In today's global economy, it's sometimes difficult to distinguish domestic and foreign companies. Most large U.S. firms conduct significant operations in other countries in addition to having substantial export sales from this country. Differing political and economic environments from country to country mean risks and associated rewards sometimes vary greatly among the various operations of a single company. For instance, manufacturing facilities in a South American country embroiled in political unrest pose different risks from having a plant in Vermont or even in Canada. Without disaggregated financial information, these differences cause problems for analysts. But U.S. GAAP requires an enterprise to report certain geographical information unless it is impractical to do so. This information would include revenues from external customers attributed to the enterprise's country of domicile and attributed to all foreign countries in total from which the enterprise derives revenue. long-lived assets other than financial instruments, long-term customer relations of a financial institution, mortgage and other servicing rights, deferred policy acquisitions costs, and deferred tax assets located in the enterprise country of domicile or other foreign countries in total in which the enterprise holds assets. Financial analysts are extremely interested in information concerning the extent to which a company's prosperity depends on one or more major customers. So if 10% or more of the revenue of an enterprise is derived from transactions with a single customer, the enterprise must disclose that fact. This includes the total amount of revenues from each such customer and the identity of the operating segment or segments reporting this revenue. The identity of the major customer or customers need not be disclosed, but companies routinely provide that information. U.S. GAAP requires companies to report information about reported segment profit or loss, including certain revenues and expenses included in reported segment profit or loss, segment assets, and the basis of measurement. The International Standard on Segment Reporting, IFRS number 8, requires that companies also disclose total liabilities of its reportable segments. So, since we are done with this chapter, what I'd like to do is just go over a couple problems at the end of the chapter. So what I'd like to do is start with the problem 3-4, just to help you understand the balance sheet preparation. So as you see here, the following is the ending balances of accounts at December 31st, 2018 for the Weissmuller Publishing Company. So it gives us various assets, gives us some liabilities, and then it asks us, or gives us additional information. Prepaid expenses include $120,000 paid on December 31st, 2018 for a 2-year lease on the building that houses both the administrative offices and the manufacturing facility. Then it also tells us investments include $30,000 in treasury bills purchased on November 30th, 2018. The bills mature on January 30th, 2019. The remaining $110,000 includes investments in marketable securities, equity securities, that the company intends to sell in the next year. Number 3, deferred revenue. As you see on the books, it shows $80,000. Deferred revenue represents customer prepayments for magazine subscriptions. Subscriptions are for periods of 1 year or less. Number 4, the notes payable account consists of the following: a $40,000 note due in 6 months, a $100,000 note due in 6 years, and a $60,000 note due in 3 annual installments of $20,000 each, with the next installment due August 31st, 2019. And then number 5, the common stock account represents 400,000 shares of no par value common stock issued and outstanding. The corporation has 800,000 shares authorized. So it's providing this information so you're able to classify current or long-term. So as we go and look at this problem here, you see under current assets, we show cash and cash equivalents of $95,000. Now I'm going to flip back and forth just to make sure I am providing you with all the information. In this figure includes the $30,000 in U.S. Treasury bills. So this $95,000, if we look at how it shows here, we had cash of $65,000. So we're going to include the additional $30,000 in Treasury bills. The short-term investments of $110,000, let's look and see what that provided us with. The $110,000 short-term investments, which were the marketable equity securities. Then we have accounts receivable, net of allowance for uncollectible accounts of $16,000. We show $144,000 there. Inventories of $285,000, taken right from there. Expense of $88,000. Now one of the adjustments for that would be it excludes $60,000 in prepaid rent for the second year on the building lease. So we have our total current assets to show $722,000. Then our machinery and equipment, $320,000 less our accumulated depreciation of $110,000 gives us our net property, plant, and equipment of $210,000. Our prepaid expenses of $60,000 would then give us our total assets here of $992,000. As you see here, we've got in current liabilities our accounts payable of $60,000, our interest payable of $20,000, our deferred revenues of $80,000, taxes payable of $30,000, notes payable of $40,000, current maturities of long-term debt $20,000, for our total current liabilities of $250,000. Our long-term notes payable would be the $140,000, for our total liabilities of $390,000. We then have our common stock, no par, 800,000 shares, but 400,000 shares are issued and outstanding for 400,000. Our retained earnings of $202,000 gives our total shareholders' equity of $602,000. Next, let's look at problem 3-6. So here again we've got ending balances for Vosburg Electronics Corporation, and then we have some information showing the common stock represents 1 million shares of no par authorized, 500,000 shares issued and outstanding. The loans to the employees are due on June 30th of 2019. The note receivable is due in installments of $50,000, payable on each September 30th. Interest is paid annually. Short-term investments consist of marketable equity securities that the company plans to sell in 2019, and $50,000 in treasury bills purchased on December 15th of the current year that mature on February 15th of 2019. Long-term investments consist of marketable equity securities that the company does not plan to sell in the next year. Deferred revenue represents customer payments for extended service contracts. 80% of these contracts expire in 2019 and the remainder in 2020. Notes payable consists of 2 notes, one for $100,000 due on January 15th, 2020, and another for $200,000 due on June 30th, 2021. We're going to again prepare a classified balance sheet and then identify the items that would require additional disclosure. So as you can see, I am just going to jump to 3.6. Again, our cash and cash equivalents would include the treasury bonds. We would separate out those marketable securities. Our accounts receivable, we would show net of any uncollectible accounts. The loans to employees, $40,000. Interest receivable, $12,000. The current portion of the note receivable, $50,000. Inventories, $215,000. And then prepaid expenses of $16,000 for our total current assets of $697,000. Now, investments would show only marketable securities here of $35,000, note receivable of $200,000, for our total investments to be $235,000. Property, plant, and equipment will show our land of $280,000, buildings of $1,550,000, machinery and equipment $637,000, less our accumulated depreciation on the buildings and the equipment give us our net PP&E of $1,637,000. Then our intangibles, a patent for $152,000, a franchise of $40,000, for total assets of $2,761,000. Now our accounts payable, part of our current liabilities, we'd show our accounts payable of $189,000, dividends payable of $10,000, interest payable of $16,000, taxes payable of $40,000, and then deferred revenue, the $48,000 down here, $60,000 in deferred revenue, 80% or $48,000 is current, and 20% or $12,000 would be long-term. So that's how we're splitting that up there in the deferred revenue. So our current liabilities of $303,000. Then under our long-term liabilities, we'll have the notes payable of $300,000, the deferred revenue for the long-term portion of $12,000, to come up with our total long-term liabilities, $312,000, for total liabilities of $615,000. Again, with the stockholders' equity, our common stock, no par, $2 million, and our retained earnings of $146,000 gives us our total shareholders' equity of $2,146,000, total liabilities, and shareholders' equity of $2,761,000. So those items that would require some type of disclosure, the cash equivalents, any policy used to determine what items are considered to be cash equivalents, For accounts receivable, the disclosure on the face of the statement of the allowance for uncollectible accounts if it's material. Regarding investments, the information about the type of investments and the accounting method used to value the investments. For inventories, disclosure in the policies, note of the cost method used, and if a manufacturer, the note disclosure of the breakout of inventory into raw materials, WIP, and finished goods. For PP&E, the original cost by major category is disclosed along with the accumulated depreciation, either on the statement or in a note. The method used to compute depreciation also. Then, with the long-term liabilities, disclosure in a note of the debt instruments that comprise long-term liabilities to include information such as payment terms, interest rates, collateral pledged. So I hope that has helped you in this chapter, and we will move on to the next chapter here, since we are now done with chapter 3.